63 billions vanished. The company responsible? It didn't sell anything, at least not in the ordinary sense. It sold a story, a future mapped out in charts, memos, and slide decks. Investors bought the narrative. Employees bought the stock for their retirements. And when the story unraveled, that 63 billion evaporated almost overnight. This is a story of image over substance, of clever accounting masquerading as innovation, and of a system that was more than willing to look the other way. It begins in Houston in 1985 and ends in a courtroom and a law on the books. Along the way, it raises a simple question. How does a firm that billed itself as an innovator grow into one of America's most valuable companies while, in reality, selling very little of lasting economic value? If you like deep dives into corporate scandals, subscribe. We'll unpack the mechanics, the people, and the fallout. Enron started as a fairly ordinary pipeline company. Ken Lay, the founder, watched the energy world change under deregulation. Where pipelines were once predictable toll roads, deregulation promised a new kind of marketplace. Energy could be bought, sold, hedged, and traded like a commodity. The company that once quietly moved gas began to sell ideas. That energy could be packaged, traded, and monetized in ways nobody had tried before. Jeff Skilling arrived and accelerated that pivot. He didn't want Enron to be a utility. He wanted it to be a market maker, a trader, a tech-flavored platform. Enron Online, the company's trading website, became the symbol of that transformation. The glossy proof that Enron was as much a Silicon Valley story as it was an energy story. Reporters loved it, investors loved it. Fortune ranked Enron among America's most admired companies. The aura of innovation produced what every modern company craves: credibility. That credibility, in turn, allowed Enron to tell bolder stories about future profits. Inside the company, a culture took hold that prized deals and rewarded daring. Employees were pushed to perform, to find the next trade, the next contract. Executives talked about selling the future, about contracts and structures that would produce revenue years down the line. It sounded visionary. It sounded like growth. It also created a pressure cooker where appearance often mattered more than lasting cash flow. This is where the accounting tricks come in, and where plain language explanations are necessary because the methods were simple in concept, yet devastating in effect. First, mark-to-market accounting. Imagine you sign a 10-year contract to supply electricity. Under conventional accounting, you recognize revenue as you deliver the electricity and earn money. Mark-to-market lets you estimate the total future profits from that deal today and record them immediately. Think of it as counting a decade of potential income on day one, based on optimistic models or assumptions about future prices. That's not illegal if the numbers are reasonable and verifiable. The danger appears when optimistic projections are booked as definitive profits and then used to justify performance bonuses, stock valuations, and more aggressive deals. Second, special purpose entities, SPEs. Picture this. You have a broken car that's worth less than the loan you took out to buy it. Instead of admitting the loss, you sell the car to a friend, but you secretly agree to cover the friend's losses if the car fails. On paper, you removed the liability. In substance, you kept it. Enron used SPEs like LJM1, LJM2, and a set of vehicles nicknamed Raptor to move unfavorable assets and debts off its balance sheet. Those entities were legally separate, but in many cases they were economically tied to Enron. The CFO, Andy Fastow, created and managed some of these entities, and that arrangement created obvious conflicts of interest. The result: Enron's financial statements looked cleaner than the company's true risk profile. Together, mark-to-market and SPEs let Enron present a picture of a company that was printing tomorrow's profits today and hiding its losses in places most investors didn't look. That is the financial core of the sold nothing paradox, value derived from accounting narratives, not from persistent verifiable cash generation. The mechanics alone didn't make the collapse inevitable. They had to be sold. To analysts, to institutions, to employees who were encouraged to own company stock, sometimes as a major part of their 401k savings. That's where complicity entered the stage. Wall Street analysts issued glowing reports. Investment banks structured and financed deals that, in hindsight, helped Enron smooth earnings and offload risk. Arthur Andersen, once one of the Big Five accounting firms, played a dual role, auditing Enron while also consulting for it. That split role created a conflict that soon looked catastrophic. Andersen's auditors were supposed to be the gatekeepers for investors. Instead, the line between auditing and advising blurred. When uncomfortable documents appeared, some were shredded. When red flags were raised inside the company, they were often shrugged off. Not everyone was willing to look the other way. Sharon Watkins, a mid-level vice president, wrote an internal memo that read like a sober alarm bell. She warned that Enron's accounting practices were indefensible and that the company risked collapsing under the weight of fiction disguised as finance. Her memo made its way up the ladder and later into public record. A whistleblower had done what auditors and analysts were not doing, asking plain questions about whether reported profits matched economic reality. The unraveling that followed was astonishingly rapid. In August 2001, Jeff Skilling unexpectedly resigned as CEO. The company's facade had cracks, and those cracks widened once regulators and journalists started probing. In October 2001, Enron disclosed that it had overstated earnings by $586 million, a specific and substantial correction that shook investor confidence. What followed was a collapse in market faith. The stock, which had traded near $90 at its peak, began a downward spiral. By late November and early December, the price had plunged toward pennies. On December 2, 2001, Enron filed for bankruptcy. 70,000 employees lost jobs or saw their retirement savings decimated. Market value, that $63 billion figure, was gone. The human consequences were immediate and brutal. Many Enron employees had their 401k plans heavily invested in company stock. As executives sold shares and walked away with millions, rank-and-file employees watched their nest eggs evaporate. Pensions that seemed secure vanished. The headlines were filled with anger, sorrow, and a sense that faith in corporate promises had been abused. The legal and regulatory aftermath unfolded over years. Investigations, criminal indictments, and civil suits followed. Executives faced prosecution, some were convicted and later sentenced. Arthur Andersen was found guilty of obstruction of justice for shredding documents, a conviction that effectively ended the firm's role as a major auditor. In the public sphere, the scandal changed the way companies report financial results. Congress passed the Sarbanes-Oxley Act in 2002, a sweeping package of reforms intended to strengthen corporate governance, impose stricter requirements on auditors, and increase penalties for false financial reporting. The law made it harder, at least in theory, to concoct the accounting narratives that had masked Enron's reality. But laws are only part of the answer. Enron exposed cultural failures as much as technical ones, a culture that rewarded aggressive projection over sober accounting, markets that elevated storytelling, institutions that failed to police their own incentives. It showed how charisma and slick presentations could obscure shaky underlying economics. There are a few small, sharp lessons to pull from Enron's wreckage. First, numbers on a spreadsheet are only as good as the assumptions behind them. Booked profits that depend on optimistic forecasts are not the same as cash in the bank. Investors and employees alike learned that lesson the hard way. Second, conflicts of interest matter. When the people structuring deals also benefit from them personally, transparency and oversight must increase, not decrease. Structures like SPEs can be used for legitimate risk management or abused to conceal losses. Third, external validators. Auditors, analysts, regulators must maintain independence. When the same firms that audit a company also consult to it, or when analysts are pressured by investment banking relationships, the incentives to question hard facts shrink. Finally, there's a cultural lesson about believing the narrative. Enron sold a future, the image of an energy company running markets, pioneering online trading, and generating transformational profits. That future was attractive and believable. It fit the shape of late 1990s optimism about markets and technology. But a convincing story is not a substitute for transparent economics. To be clear, Enron's collapse was not caused by a single villain acting alone. It was a product of several forces converging, a set of accounting techniques pushed beyond safe limits, executives who exploited loopholes, service providers who failed to challenge risky choices, and investors and employees who trusted the narrative without sufficient skepticism. The result was one of the most spectacular corporate failures in modern American history. Even now, the central image is still jarring. A company lauded as visionary that, when you strip away slide decks and press releases, had shifted much of its apparent value into accounting constructs and off-balance sheet entities. The real shock isn't only that $63 billion disappeared, it's that so many people were willing, for so long, to accept profits that existed mainly on slides, spreadsheets, and in the optimistic footnotes of financial statements. Enron left an imprint on regulation, on investor education, and on corporate governance culture. Sarbanes-Oxley tightened the rules. Courts prosecuted key players. But the deeper challenge is human and institutional, encouraging skepticism without stifling innovation, insisting on transparency while rewarding genuine long-term value creation. In the end, the phrase "sold nothing" is a provocative shorthand. Enron did sell something, an idea of a future, packaged as innovation and amplified by confident executives, persuasive analysts, and a credulous media. What it didn't sell was durable cash flow and honest accounting. That mismatch is the cautionary core of the story. If this unpacking left you with questions or a reaction, check the description for primary sources and links to the public filings that document how the story unfolded. Tell us in the comments, what surprised you most about how a company valued at tens of billions could collapse so thoroughly?